Right now, in January 2026, economists and financial analysts are sounding alarm bells louder than they have in years. 4 massive economic time bombs are ticking, and any one of them could detonate and send the global economy into chaos. The scary part, we're not talking about theoretical risks or distant possibilities. These are real threats that are building right now as you watch this video. And if even one of these bombs goes off, your savings, your job, your retirement, everything you've worked for could be at serious risk. This is the story of the 4 economic disasters that could define 2026 and why you need to be prepared before it's too late. Let's start with time bomb number 1, the artificial intelligence bubble. For the past 3 years, AI has been the hottest investment story on the planet. Money has poured into AI companies at a pace we haven't seen since the dot-com boom of the late 1990s. NVIDIA, the chipmaker that powers AI systems, has become one of the most valuable companies on Earth. Its stock has gone up over 1,000% in just a few years. Microsoft, Google, Amazon, Meta, they're all spending tens of billions of dollars building AI infrastructure, data centers, chips, software, everything. Venture capitalists are throwing money at any startup with AI in its name. Valuations have gone completely insane. Companies with no revenue are worth billions. Everyone believes AI is going to revolutionize everything: healthcare, education, transportation, entertainment, work itself. And maybe they're right. Maybe AI will change the world. But here's the problem. The expectations have gotten so high, and the valuations have gotten so crazy that there's almost no way reality can match the hype. This is classic bubble behavior. When everyone believes something can only go up, when valuations disconnect completely from fundamentals, that's when you're in bubble territory. And bubbles always pop. Always. Think about the dot-com bubble in 2000. Everyone believed the internet would change everything, and they were right. The internet did change everything, but that didn't stop the bubble from popping. The NASDAQ crashed 78%, trillions of dollars in wealth evaporated, thousands of companies went bankrupt. Or think about the housing bubble in 2008. Everyone believed real estate always goes up, and then it didn't, and the entire global financial system almost collapsed. AI could be heading for the same fate. The technology might be real, the long-term potential might be enormous, but that doesn't mean we're not in a bubble right now. And here's what makes this especially dangerous. The entire stock market has become dependent on a handful of AI companies. NVIDIA, Microsoft, Apple, Google, Amazon, Meta. These 6 companies make up over 30% of the entire S&P 500. If AI stocks crash, they're taking the whole market down with them. Your 401k, your retirement account, your index funds, they're all loaded with these stocks whether you know it or not. So when the AI bubble pops, and it will pop, millions of Americans are going to watch their savings get crushed. Some analysts are already warning this could happen in 2026. The hype is reaching a peak, expectations are impossibly high, and reality is starting to fall short. Companies are spending hundreds of billions on AI, but they're not seeing the returns they expected. The technology isn't advancing as fast as everyone hoped, and investors are starting to get nervous. When the selling starts, it could happen fast. Bubbles don't deflate slowly, they pop violently. Time bomb number 2, public debt spiraling out of control. The United States government is now over $36 trillion in debt. That's trillion with a T, 36 followed by 12 zeros. To put that in perspective, that's more than the entire US economy produces in a year. Our debt to GDP ratio is now over 120%. And it's not just the US. Governments around the world are drowning in debt. Japan's debt is over 250% of GDP. Italy is at 140%. France, UK, Canada, they're all deep in the red. For years, politicians and economists said, don't worry about the debt. Interest rates are low. We can afford it. It's not a problem. But guess what? Interest rates aren't low anymore. The Federal Reserve raised rates aggressively to fight inflation, and now the US government is paying over $1 trillion a year just in interest on the debt. That's more than we spend on defense, more than we spend on Medicare. It's the fastest growing part of the federal budget. And here's the nightmare scenario. As debt piles up and interest costs explode, governments have 3 bad options. Option 1, raise taxes, but raising taxes slows economic growth and makes voters furious, so politicians don't want to do it. Option 2, cut spending. But cutting spending means cutting programs people depend on. Social Security, Medicare, defense, education. That's political suicide. Option 3, print more money, just create new dollars to pay the bills, but printing money causes inflation, which destroys the value of everyone's savings. So governments are trapped. They can't tax their way out. They can't cut their way out. And if they print their way out, they cause inflation. This is called a debt spiral. And once you're in it, it's almost impossible to escape without serious pain. Some economists believe 2026 could be the year the debt crisis goes from slow burn to full-blown emergency. If interest rates stay high, if another recession hits, if investors start to lose confidence in government bonds, the whole system could unravel fast. We could see sovereign debt crises, countries defaulting on their obligations, bond markets crashing, currencies collapsing. And if that happens, your dollars, your savings, your bonds, they could all lose massive value overnight. This is why smart money is moving into hard assets: gold, silver, real estate, things that hold value when governments destroy their currencies. Time bomb number 3, inflation coming back with a vengeance. Everyone thought inflation was dead. Back in 2022 and 2023, inflation spiked to 9%, the highest in 40 years. Everything got expensive fast. The Federal Reserve jacked up interest rates to fight it, and by late 2024, inflation had cooled down to around 3%. Everyone celebrated. Crisis over, inflation is beaten, we can relax. But here's the thing, inflation isn't gone, it's just hibernating, and it could wake up angrier than before. Why? Because all the conditions that caused inflation in the first place are still here. Governments are still running massive deficits and printing money. Supply chains are still fragile. Energy prices are still volatile. Geopolitical tensions are still high. And now we've got new inflation risks that weren't there before. Trump just announced 25% tariffs on any country doing business with Iran. That's going to make imported goods more expensive. If the US and China restart their trade war, tariffs will spike prices across the board. If there's another oil shock, another war in the Middle East, another pandemic, energy and commodity prices will explode. And here's the really scary part. Central banks have already used up most of their ammunition fighting the last round of inflation. Interest rates are already high. They can't go much higher without breaking the economy. If inflation roars back, the Fed will be stuck between two terrible choices: raise rates even more and trigger a recession, or let inflation run wild and destroy savings. This is called stagflation. When you have high inflation and economic stagnation at the same time, it's the worst of both worlds. We saw this in the 1970s. Inflation hit double digits, unemployment was high, the stock market went nowhere for a decade, it was economic misery, and we could be heading back there in 2026. All the ingredients are in place. If inflation comes back, your dollars buy less, your wages don't keep up, gas prices spike, grocery bills explode, rent goes up, everything gets more expensive. And unlike stocks or bonds that can crash and recover, inflation just grinds away at your purchasing power every single day. This is why gold and silver have been surging lately. Silver just hit $91 an ounce this week. People are looking for protection against inflation. Physical metals hold their value when paper money loses its value. That's why they've been money for thousands of years. Time bomb number 4, the US-China trade war fragile ceasefire. For the past few years, the US and China have been locked in an economic cold war, tariffs, sanctions, technology bans, semiconductor restrictions. It's been brutal. Both economies have been hurt, supply chains have been disrupted, costs have gone up, growth has slowed. In late 2025, both sides agreed to a temporary ceasefire. They backed off the most aggressive moves. Tensions cooled down a bit. But this ceasefire is incredibly fragile. It could collapse at any moment. Trump is back in office, and he's already imposing new tariffs. He just hit any country dealing with Iran with 25% tariffs. China is furious. They see this as the US trying to dictate who they can trade with. If China retaliates, if they impose their own tariffs or restrictions, we're right back into full-blown trade war. And this time it could be worse than before, because both sides are more prepared and more willing to inflict pain. China has been reducing its dependence on US technology. They've been building their own semiconductor industry, their own software platforms, their own supply chains. The US has been pushing companies to move manufacturing out of China back to America or to friendly countries like Mexico, Vietnam, India. Both sides are decoupling, separating their economies, preparing for long-term economic competition or even conflict. If the trade war reignites in 2026, here's what happens to you. Prices on everything from China go up: electronics, appliances, clothing, toys, furniture, all more expensive. American companies that sell to China get crushed. Apple, Tesla, Boeing, Starbucks, they all have huge China exposure. Supply chains break again. You can't get the products you need. Shortages return. Delivery times explode. The stock market tanks, especially tech stocks that rely on Chinese manufacturing or Chinese customers. And the global economy slows down because the US and China together are 40% of global GDP. When they fight, everyone suffers. Some analysts think 2026 could be the year the ceasefire breaks, tensions over Taiwan are rising, the South China Sea is a flashpoint, technology competition is getting fiercer. One miscalculation, one incident, one aggressive move, and we're back in full economic warfare. And unlike a shooting war that might be over quickly, an economic war can drag on for years, slowly strangling growth and prosperity. So those are the 4 time bombs ticking right now: the AI bubble, the debt spiral, inflation's return, and the China trade war. Any one of these could detonate in 2026 and cause serious economic damage. But here's what really keeps economists up at night. What if more than one goes off at the same time? What if the AI bubble pops while inflation is surging, while the debt crisis is exploding, while we're in a trade war with China? That would be a perfect storm. Multiple crises hitting simultaneously, overwhelming the system's ability to respond. Central banks can fight one crisis at a time, maybe 2, but 4 at once. They'd be helpless. Governments could try stimulus, but they're already drowning in debt. They don't have room to spend more without triggering a debt crisis. The economy could spiral into a severe recession or even depression. Unemployment spikes, businesses fail, wealth evaporates. This is the nightmare scenario for 2026, and it's not impossible. In fact, some would argue it's becoming more likely every day. So what do you do? How do you protect yourself when these time bombs are ticking? First, don't be complacent. Don't assume everything will be fine just because it's been fine lately. Markets are at all-time highs, unemployment is low, people feel good, but that's exactly when the biggest crashes happen. 1929, 2000, 2008, every major crash happened when people felt most confident, when everyone thought nothing could go wrong. Second, diversify like crazy. Don't have all your money in stocks, especially not in AI stocks or tech stocks. Spread your investments across different asset classes, different countries, different sectors. Own some bonds, but be careful, because if inflation comes back, bonds get crushed. Own some real estate if you can, but not if you're over-leveraged with debt. And seriously, consider hard assets, gold and silver, physical metal you can hold, not paper promises. Third, build up cash reserves, have an emergency fund that can cover 6 to 12 months of expenses. If the economy crashes, if you lose your job, if there's a crisis, you need a cushion to survive. Cash might lose value to inflation, but it gives you options and flexibility when everything else is chaos. Fourth, reduce your debt, pay down credit cards, car loans, student loans, mortgage if possible. Debt is dangerous when the economy is unstable. If your income drops but your debt payments stay the same, you're in trouble. Fifth, invest in skills and knowledge that make you valuable no matter what happens to the economy. If you're good at what you do, if you have skills people need, you'll find work even in a recession. The people who survive economic crashes aren't the ones with the most money, they're the ones who saw it coming and prepared. Now let's talk about why these 4 time bombs are particularly dangerous in 2026 specifically. It's not just that these risks exist, risks always exist, it's that they're all reaching critical levels at the same time. The AI bubble has been inflating for 3 years. Valuations are stretched to the breaking point. Expectations can't get any higher. Government debt has been building for decades, but now interest costs are exploding and there's no political will to fix it. Inflation was supposedly beaten, but all the underlying pressures are still there waiting to reignite. And the US-China relationship has been deteriorating for years. The ceasefire is just a temporary pause in a long-term conflict. 2026 is the year when all these slow-building pressures could reach a tipping point. Think of it like tectonic plates grinding against each other. Pressure builds slowly over years, and then suddenly there's an earthquake. We've been building pressure in the economic system for a long time. Cheap money, massive debt, asset bubbles, geopolitical tensions. And now the pressure is at extreme levels. It won't take much to trigger a release. A recession, a war, a pandemic, a financial crisis. Any shock to the system could set off a chain reaction. Here's another scary thing. The people in charge don't seem to understand how serious this is. Politicians are focused on elections and partisan battles, not long-term economic stability. Central bankers are patting themselves on the back for beating inflation, ignoring the debt time bomb. Corporate executives are chasing AI hype and short-term profits, not preparing for a crash. Nobody wants to be the one who sounds the alarm and kills the party, so everyone pretends everything is fine. This is called normalcy bias, the tendency to believe that because things have been okay, they'll continue to be okay. But history shows us that's exactly when disasters happen, when everyone is comfortable and complacent. The people who get hurt worst in crashes are the ones who never saw it coming, who were fully invested at the top, who had no plan. The people who survive and even thrive are the ones who prepared, who were cautious, who protected themselves before it was too late. So where does that leave us? What's the most likely scenario for 2026? Honestly, nobody knows for sure. Economic forecasting is notoriously difficult. There are too many variables. But here's what we can say with confidence. The risks are real, they're serious, and they're all active right now. The AI bubble will eventually pop. The only question is when and how bad it will be. The debt spiral will eventually become a crisis. The only question is what triggers it. Inflation will likely come back at some point. The only question is how high it goes. And the US-China relationship will likely get worse before it gets better. The only question is whether it stays economic or turns into something more dangerous. Given all that, a cautious defensive approach makes sense for 2026. This isn't the time to be swinging for the fences, chasing the hottest AI stocks, loading up on leverage, betting everything on continued growth. This is the time to be smart, to be diversified, to be protected. Own some stocks, but not too many, and not all in one sector. Own some bonds, but understand they're vulnerable to inflation. Own some cash, even though it loses value slowly because it gives you options. And own some hard assets, gold and silver, physical metal, that's held value for thousands of years. Silver just hit $91 an ounce this week, a 5% jump in one day. That's not random. That's investors seeing the same risks we're talking about and moving money into safe havens. When uncertainty is high, when governments are drowning in debt, when inflation threatens, when markets are unstable, precious metals shine. They can't be printed. They can't be devalued by politicians. They can't go bankrupt. They just are what they are. Physical silver and gold, coins and bars you can hold in your hand. That's real wealth that survives crashes. Not paper promises, not digital entries in a computer, actual metal. Throughout history, every time paper money systems have collapsed, and they always do eventually, gold and silver have retained value. The Romans, the Germans in the 1920s, Zimbabwe, Venezuela, every hyperinflation, every currency crisis, precious metals protected people. This doesn't mean you put everything into silver and gold. That would be just as risky as putting everything into AI stocks. But having 10 to 20% of your portfolio in physical precious metals as insurance makes a lot of sense right now. Think of it like fire insurance on your house. You hope you never need it, but you're glad you have it if disaster strikes. The 4 economic time bombs we've talked about today, any one of them could make 2026 a very difficult year. The AI bubble popping could wipe out trillions in stock market value. The debt spiral could trigger sovereign debt crises and currency collapses. Inflation returning could destroy purchasing power and savings. The China trade war reigniting could disrupt supply chains and crush growth. And if multiple bombs go off at once, we could see an economic crisis worse than 2008, maybe as bad as the Great Depression. This isn't fear-mongering. This is pattern recognition. This is understanding history. This is looking at the data and seeing where it leads. The warning signs are flashing red. The question is whether you're paying attention. Most people won't prepare. They'll ignore the warnings. They'll assume someone else will fix it. They'll hope for the best. And when the crash comes, they'll be shocked. They'll panic. They'll lose everything they worked for. Don't be that person. Be the person who saw it coming, who prepared, who protected their family and their wealth. If this video opened your eyes to what's really happening, hit that subscribe button right now. We're going to keep tracking these 4 time bombs throughout 2026, giving you updates, warning you when things get critical. The mainstream media isn't going to tell you the truth. They're too busy cheerleading the stock market and protecting their advertisers. But we're going to give it to you straight. The good, the bad, and the ugly. Drop a comment below and tell me which of these 4 time bombs worries you most: AI bubble, debt crisis, inflation, or China trade war. And if you know someone who needs to hear this message, share this video with them, because we're all in this together. Thanks for watching. This is the real story of the 4 economic disasters that could blow up 2026. The time bombs are ticking. The question is whether you'll be ready when they explode. Stay alert, stay prepared, and I'll see you in the next one.